Geopolitical tensions have been building into economic storm clouds. From the Middle East to Asia to Europe, conflicts are creating ripple effects that threaten global markets and economic stability. Today, we bring you insights from the guests on my show who have been tracking these developments and their implications for markets. We begin with Xueqin Jiang, host of Predictive History on YouTube, an expert in geopolitics. He recently went viral on the internet with his prediction of the U.S. military's involvement in Iran a full year before it happened. Here he was on my show summarizing the current state of global conflict. And as always, if you're new here, subscribe and hit that bell notification to get daily updates on interviews from the world's preeminent financial experts.
It's very scary how these conflicts around the world, you have the Russia-Ukraine conflict, you have the conflict between Israel and Iran. It's very scary how these events are converging together in the Middle East. And so, I mean, if there's a war in the Middle East, the entire world is dragged in because East Asia gets a third of its oil from the Middle East. Japan gets 90% of its oil from the Middle East. East Asia could not survive without oil from the Middle East. And all Iran has to do is to close off the Strait of Hormuz, and they basically collapse the East Asian economies. So East Asia has to be brought in. Russia will be brought in order to defend Iran for many reasons, not just geopolitical, but also religious reasons. And I talk about this in my channel as well. Russia, Putin, they will protect Iran to a certain extent if there is an invasion. NATO will be brought in because the conflict in Ukraine will get worse and worse. And my prediction for the war in Ukraine, okay, is that the war will shift to Odessa at some point. So the next big battle in the war in Ukraine is Odessa. And also what's really important is Odessa will be the last stand of NATO in Ukraine. NATO will commit its full might to defending Odessa. And if that happens, then Turkey will be brought in because Turkey controls the Bosphorus Strait, which gives NATO warships access to the Black Sea. But basically, if you just look at a map and you look at what's happening in Ukraine, you look what's happening in the Middle East, and you believe that these conflicts will only get worse and worse, then at some point they'll converge together, and at some point the entire world will be brought into this region for World War III.
These geopolitical tensions are not abstract concerns. They are creating measurable economic pressures in the U.S. Gareth Soloway, chief market strategist at Verified Investing and expert swing and day trader, explained how current conditions are potentially setting up a dangerous stagflation scenario.
I think all of this combined with an uptick in inflation is really making the markets nervous because remember, these tariffs are going to go into effect and they will cause some sort of slight, if just slight reaction in inflation, which means higher inflation, but a weakening economy. And again, we know what that means. That's that favorite term of stagflation. So I think that's where we are right now, David.
Danielle DiMartino Booth, CEO of QI Research and former Fed insider, reveals the underlying weakness in labor markets. Is he right about the unemployment front specifically?
I don't think he is. I don't think the labor market is near as solid as he portrays it to be. He is singularly trying to shift our focus to the unemployment rate, to kind of shift our focus away from non-farm payrolls as the labor market conveniently contracts in size with immigration at a standstill and deportations taking on, meaning mathematically speaking, it's going to be harder to increase the unemployment rate. So I don't agree with his assessment of the labor market. Most Americans don't agree with his assessment of the labor market. And I think there's something to be said for tone deafness on the chair's part.
And Joanne Hsu, director of the Surveys of Consumers and professor of economics at the University of Michigan, discusses how consumer confidence is now deteriorating.
Consumer views of labor market expectations are actually quite weak. We have 2/3 of consumers who are telling us that they believe unemployment rates are going to rise in the year ahead. And moreover, they expect to be personally affected. When we ask people, what's the probability that you'll lose your own job in the next few years, that's at elevated levels. millennials, when we ask about their income expectations, that's weaker than usual and has been weak for some time. So it seems that the strong incomes that supported consumer spending post-pandemic, those expectations might not really be there to support consumer spending in the year ahead.
The economic warning signs are translating into unprecedented market behavior. Technical analyst Chris Vermeulen, chief market strategist at thetechnicaltraders.com, discusses why his models are flashing major correction signals.
Big correction is here, and gold is one of the biggest. It's kind of like a global barometer that we're going to go into some financial crisis in a big way, and that's why I think gold is performing so well, and why gold I think is close to a 20 to about 40% rally, depending on what happens over the next really week or two, or really actually just next week. I think we're going to have a significant change where we have big trends, either up or down. We just have to let these assets break out, whether it's gold or the stock market going forward.
Sam Burns, chief strategist at Mill Street Research, provides historical context for this volatility.
From an all-time high to a decline of at least 18% to back to a new all-time high in at least since 1960. In the data I looked at. So this has been a remarkably fast, decline and then reversal back up again relative to all previous kind of declines of this magnitude. So that's kind of what the model there is capturing, because some of the components of it do try to stay in harmony with the overall market trend and momentum and risk appetite in particular. And that's really been the factor that's changed, as people went from very bearish to very bullish within a matter of almost weeks, really. Which is very unusual.
And Thomas Hayes, managing member at Great Hill Capital and hedge fund manager, explains concerns about data reliability affecting market confidence.
CEO confidence come back. As a matter of fact, last week was the biggest week in years for deal activity, M&A, et cetera. The investment bankers in the Hamptons aren't playing golf. They're busy on the phones in August, which is pretty unusual. So animal spirits have come back. And I think that it might be more of a rear view looking mirror phenomenon, but it's also a message to the Fed like, hey, you really are too restrictive and you really are too late, because once the unemployment starts to tick up, it's very, very hard to put that genie back in the bottle. Inflation, on the other hand, you can quell pretty quickly. So in other words, when you think about risk reward in terms of a dual mandate, let's assume this trend persists and the weakening job market persists, and it wasn't solely attributable to Liberation Day and the uncertainty around Liberation Day. Well, then you're probably already too late with cuts. However, if it is a short-term phenomenon, and let's say you cut too early and all of a sudden employment starts roaring back with CEO confidence and C-suite confidence, and inflation ticks up because you cut too quickly, well, it's very easy to quell inflation. You could simply do a hike of 25 or 50 basis points and put inflation back in the jar. You can't do a cut, 25 basis point cut and put unemployment back in the jar. It just continues to persist, and fear builds upon fear builds upon fear.
Market volatility reflects deeper concerns about resource security and supply chains. Lyn Alden, macroeconomist and founder of Lyn Alden Investment Strategy, shares her energy sector positioning strategy amid these geopolitical risks.
Like a perpetual option on Middle East destabilization or anything else that might drive energy prices higher. And in the meantime, it pays me to own it. And so right now, we're generally seeing that at current oil prices, U.S. shale is kind of gradually stagnating. So there's not a lot of drilling activity. It's not really encouraging a lot of new investment.
Sam Burns again examines the commodity signals that suggest broader economic weakness ahead.
Particularly for manufactured goods, that the sort of industrial metals like copper and zinc and aluminum and things that are used to actually create things, whether it's houses or cars or whatever, is kind of a measure of demand, of actual global growth. Whereas precious metals like gold are much more sensitive to investor sentiment, inflation worries, currency worries, those are much less tied to kind of real economic activity, as well as central bank policy. And of course, part of the reason gold has been going up has been central banks, including China, trying to diversify away from the U.S. dollar, amid concern that sanctions and things like that will become more of a factor for other countries that use the dollar in international transactions. So, to me, it reflects both the concern about currency and inflation that is pushing gold up, and the fact that China's economy has been struggling. Global growth is likely to be slowing, and particularly for the manufactured goods that are going to be affected by tariffs, that's suppressing demand for those industrial metals that are sensitive to those things, and particularly via China.
Beyond immediate market concerns lie structural vulnerabilities in the global financial system. Lyn Alden explains how fiscal dominance creates long-term systemic risks that compound these geopolitical uncertainties.
And to the extent that it snaps back a little bit, it's potentially higher employment. But basically, the biggest reason for that, number one, is demographics. So we started to enter an older demographic period, and because our economy has a pretty extensive entitlement system, that means more people drawing from Social Security and Medicare than paying into it, and so that increases our deficits even at a time when we have low unemployment.
The experts we heard from represent different specializations but converge on a central theme. Geopolitical storm clouds are creating economic headwinds across employment, inflation, energy, and financial markets. These are not isolated risks, but interconnected vulnerabilities that demand careful attention from investors. Comment below on how you view the current state of the market amid these geopolitical uncertainties, and don't forget to subscribe to my free newsletter as well with more insights and information linked down below. Thanks for watching.